Hello and welcome to the YouTube podcast series of Cities ABC and Open Business Council, Fashion ABC and Dennis Guarda. I'm Hilton Super, the Vice Chairman of Studium Group, and I'm looking forward to interviewing today Omid Melekan, who's the author and adjunct facility in cryptocurrency and blockchain technology at Columbia Business School. Here we interview people who are changing the world, people who are inspiring us with their achievements and their creativity, their acumen, and especially in the use of technology. Now, in previous interviews, Dennis Guarda and I have interviewed over 200 amazing people, achieving more than 13 million views on YouTube. This interview series on Cities ABC is in partnership with our platforms openbusinesscouncil.org and fashionabc.org. All fourth industrial revolution-based technologies utilizing and employing truth and trust through the use of blockchain and the deployment of data analytics, AI, and machine learning. So stay tuned to the podcast series soon, and don't forget to check out Cities ABC YouTube channel, citiesabc.com, and openbusinesscouncil.org. So, Omid, a great pleasure to meet you today.
You as well, Hilton. Thank you for having me.
I'm looking forward to talking to you a little bit about truth and trust. In particular, you're an author, and the work that you've been doing at Columbia Business School and lecturing on blockchain and crypto. And also you come from economics background, and you actually come also from an asset management background, particularly quantitative asset management, which is something we'll talk about a little bit later. But as a veteran in the industry, getting involved very early on in crypto and blockchain, you've become an advisor to many institutions and written many books and blogs and authored, I think your first book was The Story of Blockchain, which was basically a beginner's guide that nobody understands. And you published that in 2018. Yep. And your recent book, which is Re-Architecting Trust, which is an update, I think, of that, looking at the curse of history and the crypto cure for money markets and the platforms, which provide the reader with a guided tour of the money markets, the platforms that are involved, and the things that can go off the rails. In terms of the players in the industry and basically trying to reinitiating and reinstalling faith in users through your book. So tell me, when did this whole journey start? When you were at school, how did you come to be curious about new technologies?
Well, I guess part of it is my age, which is that I am of the age or the generation where I got my first home computer, I think when I was 14 or 15 years old. And that was a rare thing back then. Only nerds like me had computers at home. And there actually wasn't that much you could do with it. It's kind of funny to think back. Like before you could connect a computer to the internet and communicate with other computers, you could type things, you could play video games, which is probably the main thing that I did. And for business reasons, because people had spreadsheets and professional software, which I did not use. But I still remember the first time I used a modem on my computer to connect to something called the bulletin board service, which was like a proto-internet thing that some individual was running. I was of that generation where I had America Online at some point for internet, and you would pay some amount to have something like 10 hours a month. And then when I began college, there was broadband internet at college, fast internet. And now I'm in a place where everyone's computer is connected. Mm-hmm. So I have vivid memories of the digitization of the economy, starting at the simplest activities. And I think that always imprinted in my brain this idea of the design of the world and the economy and how technology changes it. I didn't go into technology. Like you said, I had more of a financial background. I was a trader for a few years. I worked in other capacities on Wall Street related jobs. And that purely by accident ended up being what I consider a very helpful background for what I do today. Because I think if you approach blockchain and crypto from a place of understanding how the existing financial system works and why it's built the way it is, then you can better grasp why it's time for a major upgrade.
Indeed. So when you started, you read obviously economics at Columbia University, and you immediately went into the capital markets and you started working in Formula Capital, which was basically gave you a very quick understanding of starting up a business and raising money and running a fund and hedge fund. Tell us a little bit more about it.
The timing was also interesting because that was also the beginning of the hedge fund boom. Some of your younger listeners or viewers might not know this, but up until the early 2000s, hedge funds have been around for a very long time. And there were some big famous ones, people like George Soros, but they were very much kind of like a niche aspect of financial services. And what happened was that after the dot-com bubble burst and we had the 2001, 2002 bear market and recession, hedge funds really stood out because they were able to make money at a time when people who just held stocks or bond or the kinds of active managers who were the main cohort back then, which were people like mutual fund managers, they all lost money. And then suddenly the world started saying like, wait a minute, what are these other kinds of financial entities that do things like do quantitative trading, short things, put on macro trades, look for statistical opportunities and stuff, and they can make money regardless of whether stocks and bonds go up or down. And that began what I consider like almost like a 20-year cycle in which now the hedge fund world and the asset management world, or what we call the buy side, is far more prominent than, say, the investment banks, which we used to call the sell side. And of course, what happened in 2008 and the financial crisis played a big role in that too.
Yeah. But what's interesting is when we talk about the word hedge funds, that word has become a synonymous with anything that is different. Where in the traditional sense, where you and I were starting, we were talking about hedge fund, which is basically a hedge against something. So you buy something that is cheap and you sell something that is expensive, or you buy something and it's equally balanced so that whatever happens, the cheap things get more expensive and then the expensive things get cheaper, and that's where you make your money. What we see today is anything that just feels like something different to stocks and bonds is called a hedge fund.
Yeah, pretty much. It's become this catch-all term for people who raise money and explore an ever-growing list of strategies to deploy that money. Some of which in the last couple of years, there are now crypto hedge funds that look for various kinds of opportunities in these brand new financial markets that didn't exist even 5 years ago.
So tell me, what was your big takeaway from running sort of statistically based asset management with some form of discretion built into it in terms of when you switch the model on and off, basically, I think. Tell us a little bit about the big lessons learned then and how those lessons learned then should be applied to the uses in technology-based strategies today.
The biggest lesson that I learned is that I was not particularly good at it, which I can admit now, which I think is universal, by the way. I think there are very few people who can, as deploying any kind of active investing trading strategy, can outperform the markets in the long run. And I think those who are good at it, it's just a special talent that they have. It's not necessarily something that could be taught or trained. And that doesn't mean that other people shouldn't invest or try to get appreciation out of their capital. It just means, as I learned the hard way, that you should be very humble about what you don't know and what might happen, which is a lot. And certainly having lived and traded and managed other people's money through the 2008 financial crisis, I learned perhaps the oldest lesson, which is the one about how the market could be wrong for a very long time, and that things like liquidity and risk management and leverage, which I know you know all too well about. Unfortunately, within the crypto industry, what often happens is that, in part because these are unregulated markets, a lot of people gravitate to using crazy amounts of leverage, which actually makes no sense because this is already a highly volatile asset class. It's one thing if people use a lot of leverage in something like the foreign exchange market, where maybe like a currency moves 5% against another currency in the course of a year. But to layer on leverage into highly volatile industries just significantly increases the risk of catastrophe and gamblers' ruin. So I think actually the biggest lesson that I learned is that anytime you're doing anything risky with money and finances, the goal is not to get rich. The goal is to survive. And what you'll see is that in the bull markets, there are a lot of people who seem to be geniuses because they're getting really rich. And then when the cycle turns, those are the same people who blow up and lose everything. And if you can manage to hold on from cycle to cycle, in time, market appreciation combined with perhaps some level of skill in your part should result in life-changing returns.
And diversification at the end of the day, so that you would basically ride out those market cycles and diversify across various asset classes. No, I understand. And also at the end of the day is don't fall in love with certain strategies when they're losing.
That was, I wish I knew that lesson about 15 years ago, but the ones you learn the hard way are the ones that stick for the rest of life. So exactly. I'm not complaining.
So to tell me about lessons learned. You were very early on in terms of you were introduced to Bitcoin back in 2013. Tell me that story.
I had a friend who asked me to help her acquire a little bit of Bitcoin. I, like most people, didn't know much about it. And my opinion, if you had asked me, was probably negative, like, oh, I don't know, it's some stupid internet thing that only appeals to drug dealers. But I thought it would be interesting to learn on somebody else's dime, as it were. Mm-hmm. And also, I have no technical background, not really. There's so much about crypto that is highly technical. And one of the reasons why it's so confusing, I didn't know any of those things. And I just say that because I meet people all the time who are like, oh, I like to get involved in the industry or do something, but I'm not technical. And I tell them, neither am I, and I'm teaching the subject now. You can learn the technical things that you need to. But anyway, I opened an exchange account for this friend and bought her, I think it was a couple $100 worth of Bitcoin at the time. And that part of the process to me was actually exactly the same as when I used to trade futures. You open an account, deposit cash from a bank account. There's an order book, and you place a limit buy order, and if it hits, then you own something. But in doing a little bit of research, I knew that you did not want to keep your assets on an exchange. And this is something very unique to Bitcoin and other cryptocurrencies, in that you have the option to take custody yourself in the way that previously you could only do with cash, and once long ago, things like stock certificates. And the reason why is exchanges are great honeypots for hackers and attackers. And this was also when I was doing this for my friend in the aftermath of the world's biggest Bitcoin exchange being hacked, and something like 7% of all coins being stolen. So I, without having any idea what I was doing, I followed a tutorial on YouTube or something, and I withdrew my friend's coins to a wallet that I had installed on my computer. And when the wallet popped up an alert that said, your Bitcoins are now here, I was both mesmerized and thoroughly confused. Because if there's one thing that you learn working in the traditional financial system, it's that your assets are never here. There are always an endless series of intermediaries who sit between you and something that you ostensibly own. And they include the brokers, the exchanges, the custodian, the banks, the clearinghouses, and it goes on, and all for good reason, mind you. And here I was, and while I didn't know much of anything about crypto or blockchain, I knew enough to know that I had now taken full possession of a digital asset that only existed on the internet. So that was very unique. I also knew enough to know that if I made the smallest mistake, I might lose my friend's coins forever. And unlike a futures account, you can't just call someone and say, "Hey, I'm locked out here. Can you reset the password," or whatever. And this last feature is really what struck me, because then, and to a lesser extent now, it is often presented as a bug, as a flaw of crypto. Even with that big exchange hacking I referred to back then, a lot of my Wall Street friends would make fun of it. It'd be like, "Oh, look how stupid this Bitcoin thing is. It can be stolen and not replaced." And for me, it was like, well, so can anything else that's valuable. It's just that until the invention of Bitcoin, this idea that I now have the vocabulary to explain that digital scarcity, it did not exist. Right? Like no one ever worries that, oh no, what if someone hacks YouTube and steals all of your podcast episodes?
Yeah.
Because they're free and infinitely replicable already. And that's one of the reasons why so much digital content is borderline worthless, and it's hard to monetize it other than doing something like relying on an intermediary to provide ads on top or something. So that was the beginning of my personal multi-year journey to get to where I am today, where even though I didn't even have the words to express it, somewhere in the back of my mind was this idea that if you can introduce the kind of scarcity that has always existed for cash and gold and baseball cards to digital assets, that was going to be a big deal.
Brilliant early adopter and understanding, and then the sort of just that instinct that this new asset class, can I call it digital asset class, is a way of a store of value that could have great utility for society and the economy going forward, which essentially was driven by a technology called blockchain. So when did you start getting into the weeds of blockchain and understanding that?
It was very slow, and I should make clear, while I had this instinctual feeling, I did not understand how any of it remotely worked. And it took me years to be able to build a basic understanding of the technical underpinnings of like, what is a blockchain? What is mining? What do we mean when we say a wallet, a token, a smart contract, etc.? But it was early enough that I sort of had like the pleasure of learning on my own terms. I had no goal other than to understand, and it was also this like fun, quirky community of some very interesting people, and in some ways some of the most intelligent people I've ever met. So I felt lucky to just get to like sit on the outside and observe and learn, and of course crypto, blockchain, everything was a lot smaller back then, both in terms of people and applications. And then in the 2016 and 17 period where we had that crypto bubble, that's when I thought that this would be an opportunity for me to actually build a new career around it. So that's when I wrote my first book and launched what has been a extremely rewarding, if uneven, new career.
Yeah. So that was when you joined City Ventures.
Yeah, shortly after. So when the book came out, I also took a gig as a subject matter expert at City Ventures, which is a corporate VC arm of Citibank. And I was there for 3.5 years until earlier this year. I was not very involved with the venture investing part of what they did, in part because they didn't do any crypto-related venture investing until towards the end of my tenure. But it was a great role to have because City Ventures had this dual mandate of also helping the rest of the bank with innovation and digitization. So I got to spend a lot of time with people who worked all over the world, doing everything from capital markets to payments to consumer activity to research, all the things that go on in a big global bank. And while I tried my best to also inform them about blockchain and Bitcoin, the learnings that I got from that role about the plumbing of the existing financial system was instrumental to me forming the thesis that I present in my new book that came out earlier this year, Re-Architecting Trust.
Yeah, but this is very interesting. Is that you spent some time within a bank, effectively. I know it was the venture side, and talking to all the different stakeholders within the organization, focusing on what is perceived by the banking industry as smoke and mirrors, very dangerous, full of charlatans and speculators. But there's elements of that which should be embraced by the financial industry if we can get that trust aspect well understood within the system.
Absolutely. And I think it's inevitable. In fact, my message towards the end of my tenure at Citi was, this is going to happen, because as my level of understanding grew, so did my confidence that this would be a tremendously disruptive technology, first on the financial system and then on other aspects of the economy too that we can talk about. So my message to anybody who wanted to hear it at Citi and also elsewhere on Wall Street was, this is definitely coming. It's going to happen because this is a useful technology that solves important problems. And it's better suited for the modern borderless digital world than banks are. But that's not to say that we won't have banks in the future. That's not to say that we won't have centralized financial institutions play an important part in this transformation. I believe they always will. And the opportunity for now is actually for the existing incumbents to make an impact. However, history is not going to wait around for them. If they don't do it, somebody else will.
I mean, it's very difficult for very large institutions who have very, very large balance sheets to essentially become innovators.
Yeah. And add to that highly regulated institutions.
Mm-hmm.
And then in a industry where there really has not been competition in a very long time. Like, there's practically no competition on Wall Street. A lot of the big players are government-blessed monopolies. Like, if you think about like a national exchange, like the New York Stock Exchange or the clearinghouse. And then where you do have seemingly some competition, like, sure, there are 5 big investment banks in the US and then 3 or 4 in Europe and a few in Asia. And they might battle for a little bit of market share on the margins on like investment banking deals or payment services or something. But when is the last time some startup went on to compete with the likes of JP Morgan? The answer is never, almost. And
well, somebody did try the other day, FTX.
Yeah. Right. And crypto is actually probably the biggest competitive threat to the existing financial system. Mm-hmm. People often ask me about fintechs, but if you spend some time looking at how fintechs work, they're very iterative. They're not revolutionary. I mean, like, the simplest thing is almost all of them are built on top of the existing banking system. So while fintechs are good at having better UIs and utilizing mobile and cloud and AI and stuff like that, at the end of the day, all of the biggest fintech services are still built on this pretty old Wall Street plumbing, as opposed to crypto, where you do have you have brand new plumbing. If you look at like the Bitcoin blockchain or the Ethereum blockchain, these are new ways for people to financially interact with each other. And I actually think in time, might take 10, 15, 20 years, some of them will replace the JP Morgans of the world.
Mm-hmm. Not going to understand that, because at the end of the day, I mean, regulators technically should embrace this because it satisfies quite a lot of biggest issues with firms and regulations, is that you've got transparency, you've got trust, you know who's the other side of the trade, etc., etc. They should be going, oh my, this is nirvana. This is finally we've got a technology that allows us to do our job properly.
Absolutely, and this is how I actually increasingly, when I try to argue to regulators, government officials, banks, whoever, as to why this is inevitable, I present it in the language that they themselves have used to identify what they believe to be a trustworthy financial system. Mm-hmm. And you actually used a lot of the important concepts there about total transparency, the ability to not just replace human beings with code, but code that's executed on this, what we call a credibly neutral infrastructure that, like, unlike the existing system, it never goes down. It can be turned off by anybody. Does not discriminate against one user versus another. Like, just something that I consider still to this day a remarkable statistic is that despite its complexity, the Bitcoin blockchain has been in operation nonstop for 12 years now. Mm-hmm. And unlike anything else in the financial system, it's a 24/7 system. It's not, weekends and bankers hours. And in that 12-year period, it has never been down, and it has never made a single mistake, and it has never preferred one user over another, and it's never needed a bailout. So for all the critiques that people like to lob at crypto, some of which is deserved, it is important to note that in many ways it represents a safer, more reliable infrastructure.
Indeed. But it's at the end of the day, it's the actors within that space and the way in which it's been deployed, which is really where the challenges are.
Yes, and here I have to concede that crypto, particularly in the last few years, has attracted a disproportionate number of, at best, irresponsible people, at worst, criminal psychopaths. And this is where I put like the people like Sam Bankman-Fried, the former CEO of FTX, in that category. And there's some interesting reasons why that has happened. I actually think there's a long history. If you look at new revolutionary technologies, the first iteration of the businesses that try to deploy it tend to attract those kinds of people. And you and I remember, we're old enough that the internet was like this, and we had some of the biggest, when that .com bubble burst, right? Like people don't think about Enron and WorldCom that much today because the internet happened, right? Like the energy market grew to be a lot more sophisticated. But at the time, they were the leaders of those industries. I think Enron was voted the most innovative company 7 years in a row by one of the big business magazines or something. WorldCom was what, a $30-40 billion by market cap, one of the biggest telecommunication companies in the world. And like FTX just did, WorldCom ended up having a massive, unprecedented accounting scandal and whatnot. And then, of course, there was Madoff in 2008. And I'm listing all of these things because I hear from a lot of people considering what's happened lately, which is many black eyes for the crypto industry. I don't mean to whitewash like how bad it's been, but people ask me, like, does FTX mean the end of crypto? And I asked them, like, did Madoff mean the end of the asset management industry? And actually the answer is kind of the opposite because it's probably at least 10 times bigger than it was in 2008.
It's just got better. It shakes out the problems.
Indeed,
it allows it to be more robust.
Yeah, and it leads to hopefully smart regulations. I do believe that the parts of the crypto industry that do more resemble the traditional system, like exchanges like FTX, should be regulated. I think it's a mistake to try to regulate them the same way we regulate the New York Stock Exchange. That's a little bit like saying, like, let's regulate YouTube the same way we regulated NBC, CBS, and ABC, the TV stations 50 years ago. But they can easily be regulated. And then on the part of my industry, we need to be better at picking our leaders, and we need to be better at being generally skeptical of these kinds of people like Sam Bankman-Fried.
Mm-hmm. So basically, your book talking about re-architecting trust, you obviously touch upon these issues.
I do, yeah. But more from a fundamental point of view, because it's funny, when I set out to write this book, I was just setting out to write a crypto book, because my first one, as you mentioned, was this simple, easy to digest beginner's guide. But then 3 years later, I thought, I want to do something more ambitious now. Instead of just trying to explain what is Bitcoin, what is blockchain, et cetera, with the new book, I wanted to capture why it's important and what this is all going to change in a way that anybody can appreciate. And I ended up writing a book about trust, because in the writing process, I realized that at the end of the day, that's what we're talking about here. Because if you ask the simple question, what is money? And money is a way that different people across a society could trust each other enough to do business. Because if you and I might not agree on much, we might not agree on anything. But if we agree on the purchasing power of the US dollar or some other currency, then we can do business together. And then if someone asks me, like, what is the financial sector? Right? What are Wall Street institutions? Then to me, they are institutions of trust. Because they don't make a product. They don't really provide a service in the same way that like an airline provides a service, but they facilitate buyers and sellers or lenders and borrowers being able to trust each other enough to financially interact. And that, by the way, like if you look at the architecture of banks, if you look at the names of the biggest asset management firms, right? Like one way to name a big fund is to take a very dark color and a solid object like a rock and a stone. And why would you do that, right? What is the implication there? The implication is we are sound. We are here. You can trust us. We're not going anywhere. So trust is already fundamental to so much of what matters. And I'll expand that to like things like tech platforms, right? Like originally when things like social media came out, right, what was it about? It was about building networks where you can trust the information and who you're talking to. And so much of our old trust frameworks, to me, are failing in the face of digitization. They were just not built for a 24/7 real-time world where bits of data move around constantly. I mean, certainly the banking system, right? Like the fact that banks are closed over the weekend are somewhat absurd to me because banking is the one industry you need for every other industry. So you would think it'd be more open than every other industry. And yet like Amazon has figured out how to deliver furniture on Sundays, but your bank has not figured out how to deliver a wire on Sundays. So all of this, I think, is ripe for a redesign. And blockchain and crypto, to me, are the best way to introduce or reintroduce trust into digital interactions.
But from your perspective, the word trust, there's two things I look at technology, is to trust the individual, and that way in which technology can actually be designed to make us trustable by a way digitizing ourselves. So making ourselves a digital entity that has automatically a level of trust assigned to that representation of me, whether it's just a digital token of myself or we'll talk about that later, an avatar.
Yeah. I will tell you, there's a counterintuitive term in the crypto industry when we say something is trustless.
Yes.
If something is trustless, it means that you can trust the outcome without having to trust anyone or anything. So the Bitcoin blockchain is trustless because if I send you a Bitcoin, you don't need to trust me. And you also don't need to trust the various players, like people have heard of miners and their nodes and wallet providers. You don't need to trust any of them, and you can still trust that you're going to get that payment because the Bitcoin system is trustless. And then more recently, this has been expanded to decentralized finance and even digital identity and avatars and all of that. And this is like part of the beauty of this crypto ecosystem is that it's more trustworthy because you can trust the system without having to trust any of the participants. And this is in a very stark contrast if you think about like how banking works or even how like Twitter works, which is that you have to trust whatever's happening inside these very opaque institutions in order to trust the outcome.
Absolutely. No, I mean, essentially at the end of the day, that level of trust is, as you say, trustless. And it's a concept that not many people get. When you talk about the architecting of trust in your book, but it's the application of it that, like, for example, people have to trust the technology. At the moment, you and I are talking to each other using, video conferencing. We may message each other afterwards using a messaging app, but the technology behind the messaging app is 30, 40, 50 years old.
Yeah.
It's an early language that was used by Ericsson.
Right.
Ericsson engineers, Erlang. So, but we don't go and say, I'm messaging you using Erlang, and you have to trust me because it's, no, you're just sending a message. It's just being used by the various platform providers as a trusted messaging tool.
Yeah, and even in the original internet, a lot of people don't know this, but most of the architecture at the bottom layer is based on these free, open source, totally transparent, and ultimately in their own way trustless protocols, like the things that route the bits of data around or send our messages and emails and stuff. And this is important because, again, like the internet is something we call credibly neutral infrastructure, right? Like it doesn't really care if I'm sending you a message, someone else is sending an email or streaming a video. Unfortunately, or fortunately, I mean, this was kind of necessary. Those solutions were very limited in what they could do. And two things that they could not do was, one, transfer value. Because to transfer value, you have to be able to ensure scarcity. And, if I give you a physical dollar bill, I don't have it anymore, right? It's ridiculous to say, but that's actually the biggest benefit of a physical dollar bill. But if we want to have digital money, and it's bits of data, the protocols of the internet have nothing to say about me sending those bits of data to you and to my cousin at the same time. And then one of you ends up getting defrauded at some point. The original internet also has nothing to say about identity. Right? It identifies every machine, computer, phone that connects to it with a serial number. But that's very subpar when you want to do things like prevent people from pretending to be somebody else. And where blockchain comes in here as like a layer on top of the original internet is that you can have some arbitrary store of value, call it a token, that is ascribed whatever scarcity people want it to have. So with Bitcoin, people have heard that, there's only ever going to be 21 million coins. But you can also use it to tokenize your driver's license and other aspects of your identity. And I think both of those things, particularly when you put them together, are really going to be transformative in the years to come.
Absolutely. I mean, so looking at, as you talked about in the beginning, you talked about tokenization, you talked about Bitcoin, which are what we call like the $50 bill. If I gave you a $50 bill and then you gave me another $50 bill payback, they don't have the same serial number.
Right.
Effectively are fungible.
Yep.
And you can pass them on to it. The same thing if I send you a Bitcoin, okay, and then a week later you send me back that Bitcoin, those are two fungible elements or assets that can be set, because there's 21 million Bitcoins, and any one of those 21 million has the same value to one or the other at the same time. Whereas non-fungible tokens, which is basically uniqueness,
Yes.
which is my identity, or that asset uniqueness, or that event uniqueness, is a very, very valuable construct to enhance this level of truth and trust.
Absolutely. And your audience has probably heard of NFTs, non-fungible tokens. And this is actually the idea has been around in crypto forever, but this is a relatively new area of interest because, like you said, most of the initial applications were fungible things like cryptocurrencies, even like dollars. Actually, like sending dollars on the blockchain is one of the most popular activities for it because the infrastructure lets you send those dollars to people in places where good luck trying to send them a wire through the banking system, particularly on Sunday. But this idea of NFTs, where you could have some kind of a digital asset that's a one of one or a one of 10, it's really taken off. In fact, I was almost surprised, even though my first book, I begin by talking about Napster and the music industry and what the lack of digital scarcity did to that industry. But even me, I was taken aback in the last couple of years how much this idea of NFTs for things like digital art and digital collectibles really resonated with people. And I met all sorts of people who had no interest in Bitcoin or cryptocurrencies beforehand, but now this idea of there's an artist who they admire, and that idea works digitally. Maybe they make pictures or videos or music or whatever, and they decided to issue limited edition NFTs. So now for the first time, that artist can say, here's a picture, and I'm only going to sell one NFT or 10 NFTs in the same way that painters for centuries would, make one or five of something. So NFTs really took off for these kinds of art collectible applications. But of course, if you're on this digital blockchain domain, you can do more with them. So some of the more interesting things are you can introduce royalties. So many NFTs are programmed. So, say somebody buys a piece of art from an artist at $100, and then sometime later this thing appreciates and the buyer sells it to somebody else for $10,000. You can actually program the NFT so a 5% commission goes back to the original artist. So a lot of the excitement has to do with finally artists who work in the creative people who work in the digital domain having new business models that don't require them to rely on an intermediary like a Spotify or something.
Yes.
That was V1, and like everything else in crypto, there was an NFT bubble that's now bursting, and a lot of these collectibles went up to astronomical heights and are coming down in value. Anybody who knows the art market, the collectible market, that's nothing new. But what's happening now, which I'm very excited about, is that this idea of NFTs is now being applied to things that don't have as much value. They're not worth thousands of dollars, but they have a lot of utility.
Yes.
And the applications of using this technology for things like identity verification, for example, credentialing, right? We all use LinkedIn in the professional world. We all go in there and say, I went to this school and worked at this place. But there's really no way for LinkedIn to authenticate any of this, not in any way that scales, that would be cost effective for them. But I actually think in the not so distant future, the way the world will work is if you graduate from a school like where I teach, Columbia Business School, you would get an NFT that represents your degree. Absolutely. And it will sit in your wallet. And then if you want to apply for a job, you'll just show them this. And what the blockchain ensures is that it's authentic, because the company who's thinking of hiring you can actually be like, yep, I see you have this digital diploma. I also see that it came to you from Columbia University. Yeah. So going back to our core idea, from a trust building point of view, there are going to be countless benefits.
Absolutely. And this is where I think the technology will evolve, and providing that level of trust and utility for normal things, whether it's your identity or an asset, non-valuable things. They're personally valuable. They have economic value in terms of its utility to the individual. But But in particular, as we move in the Web3 space, this is the real challenge, where we talk about the metaverse, which is a digital twin of our world with digital assets in there. And there's always this connectivity between the digital world and the real world. And how do you ensure that there's that level of trust so that you can go wandering around the metaverse with your avatar, okay, and you're not pretending to be somebody else?
Yeah.
A rendered version of a celebrity.
Yeah. And Web3 is one of those applications. It's so new. There's no definition for Web3. Actually, it's fun for me when I put together my Web3 lecture, because part of the discussion is like, what is it? Right? Different people have different definitions, but the simplest way I describe it to people is that Web3 is an internet with property rights. Because if you think about how the internet works today, right, so much of our assets are actually online, right? Like your podcast. Right? If you're someone who is a Instagram influencer and you have millions of followers and maybe some of your posts have gone viral and something like that, like those are assets.
Yes, however, just like your social media accounts are assets because they are your identity.
Exactly. However, the way Web 2 or the existing internet is designed is you have zero property rights. That you can be, and we've seen this now, right? You can be deleted, deplatformed. Even the platform could fail, right? Even if nothing nefarious, like a lot of people are wondering what's going to happen to Twitter now. I don't know, but it's a business, and now after Elon Musk bought it, it has a lot of debt, and we're in a recessionary type of environment where ad revenues go down. What if Twitter fails? What happens to all those assets that only existed on Twitter's databases? They go away. So with Web3, you can have these, you can replicate a lot of the same services. However, because of the use of tokens, NFTs, even things we call smart contracts, you now have property rights. You can prove, no, I own this blog post, right? Like I own this following, this social capital. Mm-hmm. And I think you mentioned earlier this idea of the fourth industrial revolution. I think introducing property rights to the digital world is going to unlock a lot of value and economic productivity for the simple reason that, like, if I joke with people, I say, like, would you own an apartment in New York or London? They're like, absolutely. I'm like, would you own an apartment in North Korea? Would you invest money in that? And they're like, I don't think so. And one of the reasons why is you have no property rights. Why would you spend $1 million buying something or building a business or doing something in a place where you can be deprived of it with no due process with the snap of a finger? That's how Web 2 works. But with Web 3, because investors, users, entrepreneurs will have these guarantees of property rights from the blockchain, I think we're going to see significant investments and productivity unlocks.
Yeah. The thing is, the incumbents will find this a bit of a challenge because things like copyrights is a very difficult, the traditional ways of which I create something.
Yeah.
And it's like, for example, I create a song and, I am a musician, but then it's amplified through various intermediaries like, say, Spotify or whatever, or YouTube. And I don't get, every time that song's played, I don't necessarily get a piece of that commercial value. Right. It's a sampling methodology in terms of the collection of royalties and things like that in the basic world. Mm-hmm. How do you readdress the balance between what property rights I have and the value of those property rights, and how am I getting rewarded for engagement, and those rewards coming back to me in some way to justify the effort I put into creating those assets and properties?
The intersection of our existing laws and regulations, which are very much built for like a Web 2 type world, and then the blockchain Web 3 model is going to be very messy. And far be it from me to know exactly how it's going to play out, except to point out what you just did, which is that ultimately, like, why do the laws and regulations like intellectual property exist? To allow people to protect their assets and to make things fair. If you spend years coming up with a beautiful song, other people shouldn't just be able to monetize it without somehow getting your permission or compensating you for it. So things will have to evolve. And to the extent that we are introducing new financial avenues to creators of all kinds, which is great. You also have to deal with the intersection of this stuff with securities laws, which is also going to be very problematic because like this model that I presented earlier, the beauty, and this is already happening, that you have creators, writers, for example, who say, I want to write about X, and I want to, get money to do it because it's going to take time. And then people can actually like invest money up front and then say, all right, we're going to pay you $10,000, go do some investigative journalism about something we care about. And then when the piece comes out, the writer could actually sell portions of its ownership and potential income stream or grant them via NFTs or fungible tokens to those investors. So in a business standpoint, this is awesome. We've created a new way for independent writers and journalists to be financially viable, and for their fans, those who believe in them, to potentially benefit if they end up being successful. Unfortunately, if you ask the current chairman of the Securities and Exchange Commission, this is most definitely a security which would require that writer to have to go through a painstaking registration process that would cost God knows how many thousands of dollars. And then the token could only be traded by broker dealers. And this is all stuff that's going to be messy and society will have to sort out. But again, I think we will, because everything you and I talked about leads to a more trustworthy economy, including for creatives. And it's only a matter of time until the lawmakers and regulators realize that and make the necessary changes.
Yes. But at the end of the day, it even goes a little bit further than that. Information, the trust in information and fake news and things like that. This is very, very important.
Yes. And actually, like, we're having this moment where Web 2 social media is not doing too well. I mean, if you look at Facebook stock, Mark Zuckerberg's attempt to drag Meta into his vision of the metaverse, which is a lot more like North Korea because you have zero property rights and there's endless surveillance everywhere.
Exactly. It's like a sort of a Web 2 on steroids.
Yeah. So that's not going well. Things at Twitter are not going well. And we're having this society-wide debate about the role that these completely opaque and centralized services have had in things like polarization and politics and elections. People like me have been talking about Web3 social for years, right? What if we introduce the ideas that enable a Bitcoin and Ethereum to a social media network? So we already talked about property rights, but we can have transparency. Like if there are algorithms, we all know exactly what they're doing. There's a lot of people trying that. It's way too soon, unfortunately, I think. But I am fascinated by something you said earlier about the way the incumbents will struggle with this. And even in the social world, we've seen the incumbents develop this love-hate relationship with a lot of crypto stuff. So obviously, Mark Zuckerberg doesn't want decentralized social media to exist, because then someone like him would not be a billionaire anymore, nor would he be nearly as powerful as he is today. But Instagram now lets you connect your crypto wallet and show off your NFTs in a way where they're authenticating that, hey, someone says they own a piece of digital art. We looked in their wallet, they do own it. So the intersection of these two worlds, I think, is going to be a fascinating thing to watch in the next couple of years.
Exactly. We've had a fantastic an hour spending talking, and I'd like to do some more time with you, because I think, Omid, you really are you have some incredible clarity and a great way of explaining these complex issues and breaking them down into bite-sized pieces that we can all start to understand. And I'm really grateful for the opportunity to have you explain this to our audience, because at the end of the day, we want to share the knowledge, we want to share the experience, and we want to create a better world. And as thought leaders like yourself, I think it's important that we amplify what you talk about. And I'd love to revisit, version 2 of this podcast.
Absolutely.
If anybody wants to engage with you, how best can people engage with you digitally?
So other than reading the book, which I will just to tell your readers, I went out of my way to make it a different kind of crypto book. There's actually a lot more in there about how the world works today. Like, why is social media the way it is, for example, than there is in there about crypto. But there's enough about crypto where hopefully you will have a good fundamental understanding. Other than that, like everybody else on Twitter, I'm at Malikhan Ohms, just my last name, OMS. And then I have a blog on Medium. And if you just go to my website, omidmalikhan.com, everything that I write and do, including soon this podcast, will be listed on there.
Brilliant. Omid, thank you very much indeed for your time, your passion and your experience. And I look forward to speaking to you again.
Thank you for having me. It was a great conversation, and so do I.
If you're interested in knowing more about citiesabc.com with openbusinesscouncil.org and Fashion ABC, go to our platforms as well, as you can find me on social media and DM me, which is mainly Hilton Supra, on Twitter, LinkedIn, and Instagram. And do go to the other interviews we have done on YouTube. And don't forget to like and comment. And thank you very much for your time and engaging with this interview on Cities ABC.